Hi everyone. So welcome to the live stream today and welcome to the final week in our discussion towards the August 2022 examination as we try to bring the pieces together and most importantly focus on some critical aspects of the syllabus to increase our chances of passing the examination. Today I want to go through consolidation, and this is what I term as the consolidation masterclass, because if you are doing financial reporting or corporate reporting, consolidated financial statements, a done deal, minimum of 20 mark coming in the exam hall. But for those of you doing corporate reporting, the examiner could share another blessing with you by bringing in another theory, 4 or 5 mark question relating to consolidated financial statements, and that is exactly what I want to help you with today. So potentially, if you are doing corporate reporting, consolidated financial statement, your issues about consolidation, there is going to be 24 or 25 mark question, done deal, waiting for you in the exam hall. And it is very important that you are armed with the basic principles and the basic concepts and the way the various things must be dealt with when it comes to dealing with consolidated financial statements. If you're doing financial reporting, you also have a done deal 20 mark area for the question one in the exam hall. However, depending on how excited the examiner is, he could also bless you with some theory or written aspects of consolidation when it comes to the question five part of the exam in that case. So we don't know how excited he will be, but we know that consolidation is going to be a fundamental topic that will feature in the corporate reporting exam and in the financial reporting exam. And I see some of you guys joining. You are welcome to the stream. Give us a thumbs up on the video when you join. It helps us a lot to reach a lot of students and also a lot of people. So share the video as well if you know someone that has to join and be part of this stream or watch this video. Why not share the video with them, and let's reach as many students as possible on the stream. And if there are any questions specifically on consolidation, something that you want me to share my thought on about consolidated financial statements, you can put it in the chat or put it in the comments, and I'm going to be taking your questions as well as we get excited for our discussion this afternoon in the next few minutes. In that case, let's see who we have. We have Dem said, Dam, I think so, said, God bless you. Amen. God bless you too. Yugash. Good afternoon, Shira Martin. Yeah, good afternoon, Martin. Thanks for joining us on the stream today. And then he said, God bless you for your service to us. Always a pleasure. Uh, let's see what else we got. Teaser said, good evening. It's to be here again. I think he said it's good to be here again. In that case, and then Hasma said, good evening, sir. God bless you. Amen. Thanks for joining us on the stream. Nuruddin said, good evening. Thank you for touching on this topic. Always a pleasure. All right. So if there are any questions relating to consolidation specifically, you can drop in the comment section. Now, this week I'm looking at key topics in specific subjects. So if there is a specific topic in a subject that you would want me to share my thought on, put it in the comment section for me or put it in the chat for me. I want to hear from you and be able to assist you so that you can prepare well for your examination and most importantly pass the exam. So let me bring up my screen so that we can begin with a discussion real quick. In that case, let's see, what do I have? We're ready. I don't know. Okay. I don't know. I think there's a lag a little bit in my stream, but we should be good. So, consolidated financial statements. Consolidated financial statements. Now, like I tell you guys all the time, if something is done deal, I want to know everything there is about it. Okay? If something is done deal, I want to know everything about it because uh, if it is going to come, I want to be in the known of it very well so that I'm not screwed up in that particular case. So, consolidated financial statement. It's going to be there. Let's see what we can do when it comes to consolidated financial statements. Now, the idea of consolidation comes in because of the fact that entities or companies are seeking to expand and grow their operations. Okay, entities are expanding and growing their operations. Why? Because remember, companies exist to maximize the wealth of the shareholders. And in the maximization of wealth of the shareholders, it means that we need to generate a lot of profits, and a lot of revenue, increase our market share, and all of those things in that case. But not only that, companies don't want to pay also the tax that is required to be paid. So for sometimes tax purposes, companies would want to expand and grow, because I mean, who wants to pay tax, because there is tax planning. Okay, there is tax avoidance. Now that is legal, because that is using the various provisions and various loopholes in the tax laws to reduce your tax liabilities. All right, so but then tax evasion is illegal, definitely. So companies want to expand and grow, so they would want to make investments. Other times, companies would want to also reduce their tax liability, so they would want to invest or make investment into various entities for tax purposes. Nonetheless, that is not why we are here, because whether the company is investing or expanding, or the company is making the investment for tax purposes, that is not really why we are here. But why we are here is because of the fact that there are three options available when an entity is seeking to make investment in other entities. Three options available. So the investing entity has three options. Number one is to go test the waters. So acquisition of share options, acquisition of shares. And this is where the company acquires some shares to try to just test the waters in relation to that. And usually that acquisition will be maybe somewhere below, 25% in the company. I'm going to explain this to you in a moment, but maybe somewhere below 25%, or maybe some 10% ownership in another company. Now, if we acquire an ownership less than 25% or 10% or 5% or 1% of a company, that is not a big deal. So usually that will be treated as a financial asset. Okay, that will be treated as a financial asset. So if it is treated as a financial asset, that means that we would have to account for it in accordance with IFRS 9. That is going to be financial instrument, and that could be carried at fair value through P&L or at fair value through OCI. You know that already. We could carry financial asset at fair value through P&L, or carry it at fair value through OCI. So if a company makes an investment in another company, we buy shares in another company, and it doesn't give us any significant influence, it doesn't give us control, it is just an acquisition, then we just apply IFRS 9 financial instruments, and the entity can decide to carry it at fair value through P&L or at fair value through OCI in that case. However, sometimes the company wants to go beyond that. So the company will have second option, and that is the company to acquire a significant interest in the company so that we get significant influence. So the second option is that we will acquire a portion of the firm or have an arrangement with the company, with the investors, in such a manner that we obtain significant influence. So this is where maybe we are acquiring a little over 25%, but also below 50%. Maybe I'm going to explain that to you in a moment, so just stay with me. Maybe we are directly acquiring a little over 25%. Now we can acquire 10%, and the way the deal is structured, we will still be having significant influence, but we are assuming that we have acquired maybe a little above 25%, but below 50% in that particular case. This gives the company a significant influence, and so that is going to be referred to as investment in associates. Investment in associate. If we have an investment in associate, that means that we would have to apply an accounting standard, and that is IAS 28, investment in associate, using what we call the equity method. And we'll get into this in a moment, using the equity method. So the second option we have available is here. We want to get serious in that particular case. So what is significant influence? We'll get into that in a moment. Then the third option available is the company acquires, or the investor firm acquires, a significant portion of the company in such a manner that we are able to now control the company. If we acquire more significant portion of the company, that we now control the company, that means that we would have to then have the power. We now have the power, you know, to govern the financial and operational decisions of the company. If we have the power to govern the financial and operational decisions of the company, that means that we are going to be doing a full consolidation. We will do a full consolidation. If we are doing a full consolidation, then we are going to be applying IFRS 10, consolidated financial statements, then IFRS 3, business combination in that case. So generally, this is going to be the issue that we need to understand. And these are the three options that are available for the investor firm seeking to expand and grow, seeking to enjoy some tax benefits on our investment or income as an entity. But then let's boil down a little bit, and then let's dive a little bit deeper into what we are talking about basically. So if we have significant influence, what is that? If we have control, what is that? So let's begin with, you know, the portion. We are not here to do IFRS 9 financial instruments. We've already discussed financial instruments, so we are not here for that today. Our focus today will be on how we get significant influence, how we get control, and all of those things. Now, I'm going to be coming in from my book on financial reporting and corporate reporting there. So if you have my book on this subject or relating to any of these subjects, then you'll be able to flow along with me. But I'm going to also illustrate, so you'll be able to write or prepare your own notes in the discussion. So what is control? Simple. Control refers to the power to govern the financial and operating policies of an entity so as to obtain benefits from the entity. Okay, the power to govern the financial and operating policies of an entity so as to benefit from its activities. That is what we mean by control. That is what we mean by control. So if we say we have control over a company, then it means we have the power to govern the financial and operational decision of the entity. But this is the big question. How do we obtain control? How do we obtain control? How can we get it? If we will have the power to govern the operational and financial policies of the entity, how do we get that? Now, there is a direct way of obtaining control, and there is also indirect way of obtaining control. In other words, there is a traditional means of obtaining control, and there is the non-traditional means of obtaining control in that case. So indirect or non-traditional. Stay with me carefully here in that particular case. The direct means of obtaining control is the direct means of obtaining control. It means the direct acquisition of more than 50% of the voting rights of the company. Okay, so the direct acquisition of more than 50% of the voting rights of the entity. That's the direct way. Period. That is the way traditionally we expect that we will obtain control in an entity. That is the direct way we expect that we obtain control in an entity. That is the traditional way. So, for instance, whatever be the case, let's say that the equity shares of the company is 40,000. All right. Then we go and we acquire 32,000 of that. Then our portion of ownership, okay, percentage of ownership of the company, 32 over 40 times 100, that's 80%. That is 80%. So we have control over the company. So if we directly acquire more than 80%, sorry, more than 50% of the voting rights of the company, then that's what we got. That's what we got. So that is the issue about that. That is the issue about that. That is the first way directly we can obtain control in a company. That is the first way directly we can obtain control of the company. I see some of you guys joining. You are welcome. This is our consolidation or consolidated financial statement masterclass. This is a 25 mark question coming in for corporate reporting students, and minimum of 20 marks coming in for financial reporting students. So if you join, give us a thumbs up on the video. It helps us a lot to get more engagement. But most importantly, put in the comment section for me or the chat box any questions you have relating to consolidation, and I'm going to be providing you with some answers as we dive deeper. Also consider sharing the video, and let's reach many students across to assist a lot of people in this very important topic. But what if we don't have money to acquire, or we don't have interest to acquire directly 50% ownership? Then there are indirect means of obtaining ownership. There are indirect means of obtaining the ownership. Now, the indirect means of obtaining ownership can be through agreements, can be through the law, can be through appointment of board members, or number four, voting rights on the board. Voting rights on the board. So stay with me carefully as we expand these four thoughts. Traditionally, we can obtain control of a company by acquiring more than 50% ownership. But we can also obtain control of the company indirectly through agreements, through the law, through appointment of members of the board, or through voting rights of the board. So let's explore these thoughts. Number one, agreement. What exactly do we mean by that? We mean agreement with the other investors. The agreement with other investors. What does that mean? Agreement with other investors so that they will, transfer their ownership, their voting rights to us. Okay? So they would transfer their voting rights to us. I'm going to give you some solid points on this in a moment. What does that mean? So let's say we have a company and we acquire 20% of the company. By acquisition of 20% of the company, we don't know. Maybe that may give us significant influence or not. So either we will account for it as per IAS 28, investment in associates, or we will account for it as a financial asset as per IFRS 9, because it's 20%. That's all we got. That's all we got. But let's say that the 80%, the rest of the ownership is maybe Amma, is Kofi, is Desiree, is Kenzo, and is Bebe. So these are the other owners of the company. So let's say Amma owns 15% of the company, Kofi owns 30% of the company, Desiree owns maybe 10% of the company, Kenzo owns 20% of the company, and this guy also owns 15%. Will it be 100? I want to make sure I'm not exceeding 100. So 60, 30. Okay, so let's say they own only 5% of the company. So it can balance up 20, 60, 80. Yeah. So these are the rest of the ownership. Stay with me carefully. Stay with me carefully. We acquired directly 20% of the business. If we acquire 20% of the business, it depends. Maybe our investment will be accounted for as a financial asset through P&L or financial asset through OCI as per IFRS 19. Or maybe the 20% gave us significant influence. So we're going to be accounting for it in accordance with IAS 28 using equity accounting. But then we met with the other investors. And these are the other investors. Then we talked to them that, hey, listen, all of you, you cannot make any decision. So why not join forces with us and let's make decision together? We spoke to Amma, and Amma said, no, she's not going to do it. She doesn't want to transfer her voting right. We spoke to Kofi. Kofi said, no, he doesn't want to do it. He equally has 30%, and, he would want to make decisions about it. But Desiree said, what the heck? I don't like it. So Desiree said yes. Kenzo said yes to us as well in that particular case. Then we realized that Bebe also gave us his blessing and said yes in that particular case. So what's happening here? You realize that Desiree, Kenzo, and Bebe together own 35% of the company, have 35% voting right. So they now transfer that to us. We have 20% voting rights. So in total, we now have 50% of the voting rights of the company. So even though our direct investment is just 20%, because we now together have 55%, we will consolidate the financial statement of the investee company. That is one of the non-traditional ways that we obtain control. So agreement with the other investors to transfer their voting rights, or we control the voting rights of the company through agreement with the other investors. And that is a non-traditional way of obtaining control of the company. Is it good or bad? We have agreed with the investors and they have transferred their ownership to us. That's the first way non-traditionally that we can obtain control. Another way we can obtain control will be through the law. Through the law. So let's say that here, for instance, we have a listed company trying to invest in an unlisted company. So we have a listed company acquiring acquiring an unlisted entity. Now, remember, when a company is listed, all other things being equal, it has good corporate governance in place. Okay, it's better managed, so it has better internal control systems in place, and it is going to comply with the regulations better, so there is high compliance with laws and other regulations for listed companies. So the listed company buys, maybe let's say 30% of the unlisted company. 30%. 30%. Now I want you to stay with me carefully. If they acquired just 30% of the unlisted company, that may give them significant influence. So it should be treated as an associate. But maybe the regulators will come and say that, hey, listen, irrespective of the ownership that the listed company will have in the unlisted company should automatically become their subsidiary. Why? Because of the reasons I mentioned earlier. The listed company has a better corporate governance systems in place. They have a better internal controls in place, and they are better off going to be complying with laws and order rather than the unlisted company. So if there is any law like that, or the regulators say before this acquisition will proceed, you have to become a subsidiary, boom, we just obtain control of the company. So through the law, we can obtain control of a company, even though directly we own less than 50% of the company. That is another way we can obtain control in a company. Now, these are theory questions the examiner will ask you. Okay, these are theory questions the examiner will ask you. So it is very important you understand them in that manner so you can write out your answers. Both financial reporting and corporate reporting, these are theory questions the examiner can throw at you, and so you have to know about it very well. The third way that we can indirectly obtain control could be through uh, an agreement to appoint, an agreement to appoint, remove, and set remuneration, appoint, remove, and set remuneration of board of directors. That's the third one. So again, here we have acquired directly less than 50% of the company, but our acquisition gives us the option to appoint, remove, and set the remuneration of majority of the board of directors. Remuneration of majority of the board of directors. Then we control the company. Then we control the company. So if the company has a board of whatever, let's say they have a board of 12 people, that may make decision making some way. Let's say they have a board of 13 people. Okay. And we have acquired 35% of the company. But our acquisition gives us the option to appoint, remove, set the salary of about 8 people on the board. We control the company. What do you expect? We control 8, other people come in with 5. So we control the company. That is another way that we can obtain control of the company. Now, somebody will ask, why will we acquire a company and will be asked, even though our ownership is less than 35% or less than 50%, will be asked to appoint, remove, and set remuneration? It's all based on the deal. Acquisition and merger arrangement, it's all based on the deal. We said, hey, listen, if we are going to invest in this company, we won't invest directly to obtain control, but we want to appoint majority, remove majority, or set the remuneration of the majority of the board of directors. If you agree, we will invest. If you don't agree, go to other people. That is another way. That is another way in that particular case. And certainly, since we can set the remuneration, appoint a lot of people, then it means that we have majority of the voting rights on the board. Majority of the voting rights on the board. So this links with the third point. I mean, if we have 8 people on the board and the board is 13, if the board is making decision, what do you think will happen? Yeah, we will make we will always win as against them having just 5 people on the board. So these are the indirect ways through which we can obtain control of a company. So that is the idea there. The question we are trying to answer here is, how do we obtain the control? And we can obtain the control directly by acquiring more than 50% of the voting rights of the company, or indirectly through agreements with the existing shareholders, or through the law, or the option to appoint, remove, and set remuneration of the directors, or having majority of the voting rights on the board. Any of these options will give us control. So these are the ways through which we obtain control. Please note, if none of these 5 options it's in a certain acquisition deal, then the investments cannot be consolidated. Instead, it will be accounted for as per IFRS 9 financial instruments, or as IAS 28 investment in associate. I hope that makes sense there in that particular case. That is the issue about that. Any questions, please? You put it in the chat for me as we get excited about that. But the question that we ask ourselves is, okay, once we obtain control of the company, sometimes we may not own the entire company. So if we don't own the entire company, like if you remember my illustration here, we own just 80% of the company. So the 20%, other 20%, who are they? They are called non-controlling interest. Non-controlling interest. So stay with me carefully because I'm going to expand on non-controlling interest in a moment. Non-controlling interest. So non-controlling interest simply represents the equity that is not attributable to the parent entity. The equity of the entity that is not attributable to the parent. Now, the reason is that, you see, once we obtain control of the company, we are referred to as the parent. Then the company that we are now controlling becomes what we call the subsidiary. Becomes the subsidiary. So if we own 80%, the other owners of the company are referred to as what? Non-controlling interest. So the portion of the equity of the subsidiary that is not attributable to the parent is the non-controlling interest. So if you want a one-liner, that is what I just read to you. That's equity in a subsidiary not attributable directly or indirectly to a parent is referred to as non-controlling interest. Non-controlling interest. But in every consolidation, it is crucial to establish how are we valuing the non-controlling interest. It is crucial to establish how the non-controlling interest is being valued. So how do we value non-controlling interest? How do we value non-controlling interest? How do we value non-controlling interest? There are broadly two ways that non-controlling interest can be valued. Broadly, two ways non-controlling interest can be valued. And depending on the way they are valued and how impairment in goodwill is dealt with. And we're going to get into that also in a moment. So how do we value NCI? NCI can be valued at fair value, or so we can use the fair value method, or we can value NCI using the proportionate method. So we can use the fair value method or the proportionate method. These are the two methods that we can use to value the NCI, to place value on the non-controlling interest. Let's look at the easier one. That is the proportionate method. With a proportionate method, the NCI value is determined by looking at their portion of the net assets that the subsidiary is having. So non-controlling interest will be equal to the ownership of NCI in the subsidiary multiplied by the net assets of the subsidiary. Multiplied by the net assets of the subsidiary. Now, I am not doing anything like, oh, NCI at acquisition, NCI at reporting date. Whether we are at acquisition or we are at reporting date, these methods are applicable. So this is not looking for NCI at acquisition. It could be looking for NCI at acquisition. We will use that method. You could be looking for NCI at the reporting date. That same method is going to be applicable. All right. But that is the first way we calculate the non-controlling interest. And that is the ownership of the NCI in the subsidiary multiplied by the net assets of the subsidiary. Then we can place value on the non-controlling interest. But we can also value non-controlling interest at fair value. Okay. We can value the non-controlling interest at fair value. So if we are valuing the non-controlling interest at fair value, what does that mean? Two ways. One, it could be valued at fair value as stated in the question or as measured by the directors of the parent entity. The directors of the parent entity. If they are going with that approach, then the NCI value it will be given to us in the question. So the figure for the NCI will directly be given to you in the question. So if it is given to you in the question, you don't need to carry out any workings. You just pick that figure and then you go away, because that is the value of the non-controlling interest. Sounds good? So that is the first way, as measured by the directors of the parent entity. And that will be given to you directly in the question. You don't have to do any workings. You don't have to do anything. You just pick what has been given to you in the question. Then you go away. Then you go away. But the second way of the fair value that we can deal about is where we value the NCI based on the number of shares they own in their subsidiary. So fair value of NCI based on the number of shares in the subsidiary. Based on the number of shares in the subsidiary. So how many shares are they owning in the subsidiary? Do they have in the subsidiary? That will be the second way we can value them. So in that case, the non-controlling interest will become the number of shares they have in the subsidiaries, in the subsidiary, multiplied by the share price, the share price of the shares of the subsidiary. Very important. The share price of the shares of the subsidiary. So that is the second way through which we can value the non-controlling interest. Now, it is very important in every consolidation question, NCI will be there. Especially not every, let me not say that, not every consolidation question. If the parent entity is owning less than 50% of the, more than 50% but less than 100% of the company, the other people will be non-controlling interest, and we have to determine their value. And these are the two ways broadly we can determine their value: either the proportionate method or the fair value method. Either the proportionate method or the fair value method. I see some of you guys joining. You are welcome. Give us a thumbs up on the video if you're getting some value, and also put in the comment section and the chat if there is anything you don't understand or something you would want me to specifically share my thought on relating to consolidated financial statements as we look at this very important aspect of the discussion. So, what are we saying? Once we obtain control, we have control. But if we own less than 100% of the company, the other owners will be referred to as non-controlling interest. Non-controlling interest. Non-controlling interest. So when we have control, remember we established here that once we have control, we're going to be carrying out full consolidation as per IFRS 10, that is consolidated financial statements, and IFRS 3, business combination. The other people who own the rest of the company will be the non-controlling interest. So once we establish control, and we have the non-controlling interest, then a very crucial thing that we need to understand, which will always, always, always be required, is the concept of goodwill. Is the concept of goodwill. So let me bring up a slide on that, the concept of goodwill. So you establish, do we have control? Yes. What are the other owners of the company? NCI. Then we calculate goodwill. Now you got to be careful here, because I'm going to expand on everything that we have here to enable you to understand what is happening in that particular case. Number one, goodwill is going to be equal to consideration transferred Now, what is consideration transferred? Consideration transfer simply refers to the amount attribute the amount that the parent entity is paying to the subsidiary for the acquisition. The amount. Now, I'm going to put amount in quotes, and I'm going to explain that to you in a moment. The amount the, the parent entity is paying, just a simple language, okay, is paying to obtain control. Is paying to obtain control. The amount the parent entity is paying to obtain control. Stay with me very carefully here. Now, when we say consideration transferred, what exactly do we mean by that? The consideration transferred for an acquisition has four components, and their treatment will be very critical for us in this discussion. So, fair value of consideration transferred. There are four components. It depends on how excited the examiner is. You could have all the four in the exam. You could have all the four in the exam. The first one is cash consideration. We don't need a miracle for this. It simply tells us how much we paid to acquire the company. Or they will say we paid $2 per share, and that is it. Cash consideration, no miracle, and then we go away. But you see, in financing the acquisition, we don't only need money. Sometimes we have to make some payment in the future. So the second one is deferred consideration. Please stay with me carefully. The accounting for deferred consideration is as per IAS 37, provisions, contingent assets, contingent liability. What does that mean then? It means that the deferred consideration must be discounted into present terms using the cost of capital of the parent entity. Okay, so the deferred, when I use DC, I mean deferred consideration. The DC shall be discounted to present value using the cost of capital, using the cost of capital of the parent entity. Please be careful because we use this is about the parent. Fair value of consideration transferred is about the parent. It's about the parent. So we will use the cost of capital of the parent entity. So you calculate your present value, which is equal to the amounts to be paid in future multiplied by the discount factor. Okay, multiplied by the discount factor. Please read the question well, because there are sometimes the examiner will give you the present value. If the examiner gives you the present value, then there is no need for us to discount. Okay, if the examiner gives you the present value, there is no need to discount. All you do is just bring that present value here in calculating your consideration transferred. No miracle, no magic, that is all. But if the examiner gives you and say, or the examiner says they will pay $10,000 2 years time, you have to discount it into present terms using the cost of capital of the parent entity. Using the cost of capital of the parent entity. But you know, in IAS 37, anytime we calculate present value on something, what do we have to do? We have to calculate finance cost or do unwinding on it. We need to calculate finance cost or do unwinding. So on subsequent measurement, we have to calculate finance cost relating to the post-acquisition period. We calculate finance cost relating to the post-acquisition period. And that finance cost relating to the post-acquisition period is going to be the present value, which is the figure you will get here above, or which is the figure the examiner will give you directly if he says present value, multiplied by the cost of capital times x over 12. I am bringing x over 12 because I'm thinking that if the acquisition is midway through the year, If it is midway through the year, then we can't charge, because the finance cost we are charging should be for the post acquisition period. So if the acquisition is 6 months, the acquisition is 3 months, the acquisition is 9 months, the acquisition is 7 months, then you have to calculate finance costs for the post acquisition period, which is the 6 months, 7 months, or 9 months. Now, that finance cost, what do you do to it? How do you treat it? You know the double entry for finance cost. I'm not the one to teach you that. You know we're going to debit profit or loss, okay, with that figure, and we'll credit the deferred consideration. You know this from IAS 37. That's the same thing that we are applying here. So what happens if you are preparing consolidated statement of profit or loss? What's going to happen is that the finance cost we calculate will be added to finance cost. So we add to finance cost, period. That's all. That's all. But if we are preparing the consolidated statement of financial position, stay with me carefully, it will be deducted from the group retained earnings or consolidated retained earnings. So we debit the consolidated retained earnings, and certainly we credit the, you know, deferred consideration. So we deduct it from group retained earnings and we add to the deferred consideration. What does that mean? It means on the carrying value of the deferred consideration is going to be the present value plus the finance cost you calculated. And that may be under current liability if the payment will be made in less than 12 months, or non-current liability if the payment still has a number of years to go in that particular case. That is how we account for deferred consideration. So you have to be careful about it. Sometimes the examiner will give you both the present value and the value at the reporting date. Please listen carefully. Sometimes the examiner will give you the present value. So the examiner will say, oh, at the date of acquisition, the present value has been determined to be 100. Then at the reporting date, the value of the liability is 115. So in that case, it means the finance cost is the 15. The increase, the finance cost is the 15. So the 115, which is the value at the reporting date, is what will go to the statement of financial position, whilst your 15 is going to be added to finance cost if you are doing P&L, or deducted from group retained earnings if you are doing statement of financial position. So it depends on the context of the question. He can work with present value, in which case you have to calculate your finance cost, or he can give you the value at the date of acquisition and the value at the reporting date, and definitely the value will go up. So the difference between the two becomes the finance cost. That is how we deal with deferred consideration. Any questions, please? Any questions? Any questions? I see some questions coming up. Let's see if I can answer some of them, since they relate to some of them relate to the thing we are doing. Let's see, where did we get to? Any questions, please put it in the chat for me, or the comment section for me. Ohine said, it's my first time joining. That's great. You are welcome. Ramatu Sadiq said, good afternoon. Thank you for your work. Always a pleasure. Good afternoon, and thanks for joining us. Tranch Malinga said, may God continue using you. You are a blessing to many. Amen. Kindly help with unwinding discounts. Okay, Ramatu, that is what I just dealt with. I just dealt with in relation to the deferred consideration. I hope you understand that. What I just did in the finance course is unwinding discounts, and I hope you understand that. Let me know if it's not clear, then maybe I could take it again. Hamza said, say, I'm from Nigeria. How can I have access to lecture materials, textbooks, past question and answers? Thank you. You can WhatsApp us 0501149296. There is a number scrolling below the screen. You can WhatsApp on that number and you'll be assisted to get access to our full courses, or download our mobile application, or go to our website, insurapremium.com, as well, to get access. Billa Christopher said, "Good afternoon, sir. May God for the good work. May God bless you for the good work, I think. Thank you." Let's see what we got. Ningeza said, "Good afternoon. It's my first time joining live. May God bless you. I'm from SA, South Africa." Okay. Thanks, Ningeza, for joining us. Please, if I don't mention your name right, forgive me, okay? I don't mean to destroy your name. News Planet said, "Please, can you help explain the situation where parents purchase preference shares in subsidiary and dividend is paid to it? If they are buying preference shares, you don't get control on preference shares. It's a debt, so you treat it as a financial asset in accordance with IFRS 9. Purchases of preference share, because when you buy preference share, you are a debtor, you are a creditor of the company. So preference share doesn't give you control. We don't do consolidation if the company is buying preference shares. Acquisition of preference shares will be dealt with in accordance with IFRS 9 financial instrument, and the company can carry it at uh, fair value through P&L, or at fair value through OCI. So if we receive any dividend from preference shares, it is just recognized in the P&L account, and that is all. Because preference shares doesn't give us control. You don't buy debt stock of a company and control the company, because in the first place, preference shares doesn't give you voting rights. It is ordinary shares that will give you voting rights. So if the parent entities are acquiring preference shares, it's not a consolidation issue. It is an IFRS 9 financial instrument issue, and has to be dealt with as a financial asset, either through P&L or through OCI. Francis Jerry said, "Great job. Thank you, Francis." Um, Abugri said, "This is a step-by-step analysis. I'm enjoying it. That's awesome to hear." John Bauer said, um, "What can an acquisition be done without consideration?" Nope. Nope. That means it's a merger arrangement, sort of. Okay, that means it's a merger arrangement. So in such cases, then it is difficult for us to even establish who the parent is and who subsidiary is. And that is a question the examiner can ask you. Why is, oh, okay, he has asked that question before. Why is it difficult to identify the acquirer in some situations? And one of them is if if it is through a merger. One of them is if there is no consideration. So if, yeah, we are now together, you are like my subsidiary and I'm your parent, but nobody pays any money, then who is the parent? Who is the subsidiary? So yes, it could happen, and in such arrangements, because there is no consideration, it is difficult to establish who the parent is and who the subsidiary is. All right. Sarah Ofori said, "Ishra, please, when are you going to schedule for case study pre-scene analysis?" We've not received response or request from case study analysis. If we have, uh, received some response from that, we may arrange some time for it in the course of the week or over the weekend to deal with that. So if we have some requests from that for that, we will definitely spend some time to cover it. Then John said, under IFRS 3, how is an acquisition of assets differentiated from acquisition of business? I don't understand what you're saying. If you are acquiring an asset, that's an asset you're acquiring. That's IAS 16, IAS 40, or IAS 2 inventory. We don't know what kind of asset you are acquiring. If you acquire business, IFRS 3 is about business combination. You are buying the business, you are gaining control in the business, then you apply IFRS 3. But if you are just buying a portion of the business and you don't have significant influence, you apply IFRS 9, financial instruments. But if you are buying a portion of the business and you are getting a significant influence, then you apply IAS 28, investment in associates. So if you are acquiring an asset, asset is an asset, and you can apply IAS 16, 40, IAS 2, depending on the kind of asset. Maybe I don't get a context of your question or something like that, but you don't acquire asset and apply IFRS 3. It is when you are acquiring the business. That is why it is called business combination. Business combination. Kindly touch on contingent consideration. We're going to come to that in a moment. It's part of the fair value of consideration transferred. How is goodwill calculation affected by deferred tax implication? How is goodwill calculation affected by deferred tax implication? I don't know again the context of the question. When you say deferred tax implication, what do you mean? Because if it is part of the fair value adjustment to arrive at the net asset at the date of acquisition, if there is deferred tax that has not been incorporated by the subsidiary, then the deferred tax will be incorporated in the subsidiary's net asset before we can get the net asset at the date of acquisition, which will be used to calculate the goodwill. So I don't get the context of your question. If you're asking about fair value adjustments, that is another slide that we'll be dealing with in that particular case. So if there is deferred tax as part of the fair value adjustment and the subsidiary has not incorporated that, then we would have to bring it up in calculating the net asset at the date of acquisition, because we need a net asset at the date of acquisition so we can calculate the goodwill. Divine said, good job, sir. Thank you. Emmanuel Ohine Japan said, please, can you come again on the unwinding interest? Great job. God richly bless you. So what we are saying on the interest issue is, once you get a present value in accordance with IAS 37, provisions, contingent liabilities, contingent assets, you have to calculate the interest on that. And the interest is going to be the present value multiplied by the cost of capital of the parent entity. And if it is less than a year, then we have to do X over 12 in that particular case. And that interest, if we are preparing the consolidated profit or loss, then the interest will be added to finance cost. But if you are preparing the consolidated statement of financial position, that interest will be deducted from group retained earnings and also added to the deferred consideration, which is taken to the consolidated statement of financial position. Then I also mentioned that when it comes to the deferred consideration, sometimes the examiner will give us the present value at the date of acquisition, then he will give us the value at the reporting date. The difference between the two becomes the finance cost, which will be dealt with in the P&L account added to finance cost or subtracted from the group retained earnings if we are dealing with the statement of financial position. So that is the issue relating to that. Then Joyce Mbabazi said, I think, I guess I mentioned the name right, okay? Joyce Mbabazi. Hi, Nhyira. Thanks for the good work. I got done with my FR, ACCA, and pass. Thanks for the support. That's great. Congratulations. And continue to work hard and chatter as soon as possible. As soon as possible. Jelomi Aku said, kindly touch on the treatment step acquisition in consolidation. We'll come to that. Kindly touch. Okay, I think it's the same thing in that case. So let me bring back my slide. Then we go. So in calculating the fair value of consideration transferred, cash consideration can be there, deferred consideration. Now, deferred consideration is where, like I said, we are not making payments now, but we are making payments in the future. Now, listen carefully. If the payment we are making in the future is premised or dependent on the fulfillment of a certain criteria or condition, then we call it deferred. Sorry, we call it contingent consideration. Then we call it contingent consideration. So what is contingent consideration? Contingent consideration is future additional payment that a parent intends to make, subject to the requirement or subject to the satisfaction of some terms and condition. What does that mean? It means that, for instance, the parent company will say that, hey, listen, we're going to pay you some $100 million, maybe in 2 years' time. But we will only pay that if you are able to meet certain key performance indicators, KPIs. So, for instance, we want you to increase market share by 20%. We want you to increase profitability by 10%, or whatever criteria the parent sets for them. It means we will only pay, or the parent entity will only pay that money if the criteria is met. That is the concept of contingent consideration. Now, listen carefully. If at the reporting date, the subsidiary is unable to meet the criteria, then a reduction in the contingent consideration is an income. So a reduction in the contingent consideration is an income. So we said we will pay you 100 million. At the reporting that they didn't meet the criteria, so now we say we will pay you just 80 million. So our liability has reduced by how much? 20 million. A reduction in liability is an income. Are you getting the picture? A reduction in liability is an income. That is why we will treat it as what? An income. So if we are preparing the consolidated profit or loss, that will be added to other income. That will be added to other income. If you are preparing consolidated statement of financial position, then that will be added to group retained earnings. Why? Because reduction in contingent consideration is an income. Then certainly when we go to the statement of financial position, the new figure will be on the face of the statement of financial position, either as a current liability or non-current, depending on when the payment is going to be made. So that is the issue also about contingent consideration. All right? That's about contingent consideration. So either we have deferred consideration or contingent consideration. Next one will be issue of loan notes. Issue of loan notes. Sometimes we can issue loan notes to finance the acquisition. Now, issue of loan notes is issue of loan notes. You know that already. So it must be treated the way we treat loan notes. So on subsequent measurement, we have to calculate post-acquisition interest or finance costs on the loan notes. Okay, on the loan notes. So we bring in the value that we got in our consideration. We multiply by the cost of capital of the entity. And since it's a loan note, it's a finance cost. So the same way we dealt with the deferred consideration, how we handle it, that's the same way you're going to handle the loan notes in that particular case. So I'm just copying and taking it there. That's the same way you handle it. It's the same thing. Finance cost is finance cost. You deal with it. But this time around, you have loan notes instead. LN, loan notes. Then on the face of the financial position, the carrying amount of the loan notes will be the fair value you got plus the finance cost. That's it. So when a company issues a loan note as part of the consideration transferred, we determine the value of the loan notes. Then on subsequent measurement, you calculate the post-acquisition profit finance cost on that, and that is recognized also in the financial statements. That's the idea there. Then the last thing will be issue of shares. The last thing will be issue of shares. Normally, it is called share exchange. This is where the parent entity is issuing new shares to the subsidiary in exchange of the ownership that they have acquired or in exchange of the acquisition in the company. That is the idea about share exchange. That's the idea about share exchange. Now, the way you deal with share exchange is very important. The examiner will give you the term of how it's supposed to be calculated, but you must calculate the fair value of the share exchange. You have to calculate the fair value of the share exchange. You have to calculate the fair value of the share exchange. Now, it will be based on the policy in the question. So when you read a question, you'll be able to arrive at how much they said. Maybe they can say, oh, they issue 2 new shares for every 3 share acquired. So if they issue 2 new shares for every 3 shares acquired, then that is going to be our ownership of the company. If it is 80%, multiplied by the number of shares of the company. But most importantly, remember that when we are doing share exchange, it is the parent doing the share exchange. So we will use the share price of the parent. That's very, very important. Use the parent's share price. Use the parent share price when we are doing share exchange. When we are valuing or calculating the fair value of the share exchange, we use the parent share price. There is only one point you will use the subsidiary's share price, and that is when you are dealing with NCI. If you're dealing with NCI and NCI is being valued at fair value, and you are using the number of shares they own in the subsidiary, then you use the subsidiary's share price. But if you're dealing with share exchange, you have to use the parent's share price. But this is the sweet spot. When it comes to the share exchange, it is either the company, the parent entity has recorded it or hasn't recorded. And the examiner will tell you what is happening in the question, whether it has been recorded or not recorded. Whether it has been recorded or not recorded. If it is not recorded, then the share exchange, the fair value of the share exchange, if it is not recorded, then the fair value of the share exchange must be split between the share capital and the share premium. So we split it between the share capital and the share premium. The share capital is going to cover the nominal value of the share, which will be given to you on the face of the statement of financial position. And the share premium will deal with the profit on the issue. And I'm going to put that also in quotes, the profit on the issue. What does that mean? If the parent share price is, say, $4.5, that's the parent share price, $4.5. Then on the face of the statement of financial position, the nominal value per share is $1. Then the amount that goes to share capital will be $1 times the number of the share exchange. Times the number of share exchange, which you will calculate for. Then what is the profit? The share was 4.5. Nominal value is 1. That means the profit is 3.5. So that 3.5 will be what will go to the share premium. So it will be 3.5 multiplied by the number of share exchange. Sounds good? Now, you will do this if you are preparing the consolidated statement of financial position and the parent entity, as part of the acquisition, made a share exchange and they have not recorded it. So if they have made a share exchange and they've not recorded it, then we have to record it. So in recording it, this is how we deal with it. And these are the 4 components that we must understand when it comes to dealing with the fair value of consideration transferred. Depending on how excited the examiner is, any of these could be there. Depending on how excited the examiner is, any of these could be there. Your assignment, your responsibility is to know how to treat the cash consideration. You don't need a miracle on that because that has no subsequent measurement. But the deferred consideration, the contingent consideration, the issue of loan notes, the share exchange, these other 3 guys have implication after their initial measurement. And it is important you understand how each of these things are dealt with. So once we have the fair value of consideration transferred, then we get the value for NCI at acquisition, and we've explained that already. Then any fair value adjustment, we will get into that later on. Fair value adjustment will come in. Then we'll let the net assets to be recognized. Sorry, this is fair value of previously held interest. I will explain this later on. This is for corporate reporting students, especially when there is a step acquisition. Then we'll bring in the net assets recognized at acquisition. And we'll get into that also. So that is how we calculate goodwill. Now, you see, goodwill that we calculate can either be positive or negative. Goodwill can be positive or negative. If goodwill is positive, it means the fair value of consideration, inclusive of NCI, the fair value plus NCI, is actually greater than the net asset of the subsidiary. That is a positive goodwill. If we have a positive goodwill, then it must be recognized on the consolidated P&L less impairment. We recognize it in the consolidated statement of financial position less impairment loss during the post-acquisition period. So goodwill, positive. If goodwill is positive, that's what we do. If goodwill is positive, that's what we do. Meaning, the fair value of consideration transferred plus NCI is greater than the net asset of the subsidiary at the date of acquisition. When that happens, goodwill will be positive. If goodwill is positive, it has to be recognized on the face of the consolidated statement of financial position. But goodwill could be negative. Goodwill could be negative. Now, if goodwill is negative, it means that the fair value of consideration transferred plus NCI is less than the net asset of the company. When this happens, this is called gain on acquisition. Gain on acquisition. So in that case, it is recognized as income in the consolidated financial statement. It is recognized as income in the consolidated financial statement. In the financial statement. So if goodwill is negative, we won't have any goodwill figure on the face of the statement of financial position because it is income. We are paying less than the value of the asset of the company. We are paying less than the value of the assets of the company. But somebody will ask, why will we pay less than the value of the company? So it means that, for instance, the asset of the company is $100 million, but we paid $75 million. So it means we have gotten $25 million, and that is a gain on acquisition. But why? What will bring that in? Because you expect that you will pay more than the asset of the company, so you have a positive goodwill. But now you are paying less than the asset of the company. Why? What are the reasons why that could happen? A couple of reasons are here. Let me go to my slide and pick that up quickly. So factors accounting for negative goodwill. Remember, these are all theories the examiner can ask you. Okay, these are all theories the examiner can ask you. These are all theories the examiner can ask you in that particular case. So one, the acquirer may be good in negotiation. So probably we negotiated the deal better. So since we negotiated the deal better, guess what? We got a better deal. So negotiation can be an advantage. So even though the net asset of the company is 100, we negotiated and paid 75. I don't know what kind of negotiation skill is that, but it's there. It's possible. All right, it's possible. Number two, the acquiree has no knowledge of the value of its business, meaning that the subsidiary, the shareholders of the company we are acquiring, they don't even know the value of their own company. So ignorance of the law is not an excuse. So we there, we don't care. We have done our due diligence. We know the company's value is $100 million. We know that that is the net asset the company has, $100 million. But then we are negotiating and they said, oh, we should pay $90 million. That is a bargain. We will still negotiate that price down, even though we know we have already made 10 from the beginning of the negotiation. So if the acquiree, the shareholders of the company we seek to acquire, don't have knowledge of the value of their business, ignorance of the law is not an excuse. We will use it against them and we will punish them. Then number three, the acquiree is desperate to sell in a false transaction. So sometimes they just want to get rid of their business and go away. They are no longer interested in the business, or they need some money to do something urgently for some reason. So they just want to sell the company and get some money and go away. So these are some of the reasons attributing to the goodwill being negative. And that is what I refer to as the first part, the introductory issues, and some of the basic issues that we need to understand when we talk about consolidated financial statements. Any questions, please? Unfortunately, I have to sign out here today because, I mean, you know, we have a public sector class starting in a few minutes, and I have to jump on the public sector class before my public sector students starts to cause demonstration. So I'm going to end around here today, and I believe that you get the basic principles starting out. Remember, like I said, theory in the theory sense, corporate reporting students, especially, this is a done deal coming out for you 99.9% of the time. The examiner is going to be bringing some theories relating to consolidation as part of your questions, 4 or 5 marks. Then the main consolidation or consolidated question one, you would be having question on consolidation, and it's important you understand how you get your fair value of consideration transferred, how you calculate your non-controlling interest, and how to calculate goodwill, most importantly, because there is a special mark allocated for goodwill, and it is important you know how you calculate the goodwill. But then when you finish calculating the goodwill, the subsequent recognition of it is very important. If it is positive, less any impairment will go to the statement of financial position. If it is negative, that is an income, and so it will not be recognized on the face of the financial position, but will be recognized as any other income in the P&L and also in the group retained earnings, depending on the financial statement that we are preparing. So I'm going to conclude around here today. And God willing, on Wednesday, we will meet and then finish up with the basic principles about this. And my goal for you is to know how these minor issues are dealt with, because these are the things that will be in the notes to the consolidated financial statement. And if you know the principle, you understand the principle well, then once you read the question, you know that, oh, this is contingent consideration. This is how I deal with it. This is a deferred consideration. This is how I deal with it. Oh, there is a share exchange. They have not recorded it. Okay, so this is how I deal with it. And that is how you increase your chances of passing the examination and also being able to answer the question relating to consolidated financial statement. I always tell my student that consolidation is an interesting area, even though it has a lot of principles there. If you understand the fundamentals well, whatever question you pick on consolidation, you can get maximum marks at the end of the day. And my goal is for you to be able to get the easy marks and work yourself out so you can pass the examination. So that's it about that, and I'll catch you on Wednesday. Remember to join us. In case you've not subscribed to the channel, you can subscribe and click the bell icon, or you follow us on social media, all the platforms that you know. Wherever you are at, you search for Nhyira Premium, I will be there. From TikTok to Instagram to everywhere, I'll be there for you. But also remember to download our mobile application, because you can get access to content in our mobile application as well to help you to prepare for the exams. So AC Dusi said thank you. Always a pleasure. Ohineba said thank you. Always a pleasure. Ben said thank you, sir. Always a pleasure. Steven said thank you. You are welcome. So that's it about that. Thanks for joining me on the stream. Thanks, guys, for always, for those of you who are sharing the video and also giving us a thumbs up on the video. We really appreciate it, because that is how we are able to grow the community and together reach a lot of students. So that's it about that. And I'll catch you same time on Wednesday at 4:30 p.m. as we continue with our discussion. Till we meet again, stay safe and take care of yourself. Bye-bye.